Welcome everyone to Vested Interest. This is Shane back for another Stock Pick of the Day video. We are going to take a look at one Warren Buffett approved here. I actually picked this one up out of the recent release of the 13 Fs. Buffett is ones that I look at. I actually need to do a video on 13 Fs here. We're going to look at Heico. This is out of the industrial sector. Before we get too far into the video, if you could do me a favor and hit that thumbs up button down below if you're a dividend growth investor. If you find any value in the content, make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the vested interest community. Make sure you click that notification bell so you're notified whenever we put out any new content. We do these stock pick of the day videos Monday through Thursday on a company that's pulled back on the day to see if it is presenting any value. We're going to run through some criteria here. In the video, we're going to look at the vested interest stock screener and see if this one makes its way onto my watch list. We'll run through this criteria. This is how I set up the videos. It's also how I look at a company already in my portfolio to see if it meets the initial criteria that I look for in this screener, as well as the thousands of companies out there. It is a quick way to gauge whether or not I want to do more of a deep dive into the financials of a company. It must meet 5 of 8 or 6 of 9 if it is a financial company. I like to add in price to book for banks and insurance companies out of the financial sector. But if you use price to book, and you can use price to book for any company, make sure you are using it outside the financial sector for banks or insurance companies. Make sure you are comparing it to companies like an industrial company like Heico. You'd want to compare it to a similar company in a similar business. So this company Heico actually sells equipment to aerospace companies. We'll see that here in a minute. So you'd want to compare it to a company like that if you are going to use price to book. Don't just blindly go with the one. You can tweak this. It doesn't really work very well for companies that are not dividend paying companies. So if you're a growth investor, you'd want to change some of the criteria specifically around dividends here. Growing free cash flow would still apply, but growing dividend obviously would not. Dividend payout ratio of 75%, so on and so forth. So you can tweak this as well if you want to change it up a little bit. Now let's jump back over to Heico. You can check them out on their homepage, heico.com. That's heico.com. That is their homepage where I pulled this information from. Heico Corporation. So this does have two tickers associated with it, HEI and HEI-A. This is the one, the HEI-A is the one that Warren Buffett was buying. The only difference here, I believe, between the two is similar to like Google that has the GOOG and GOOGL. One allows you 1/10 of a say as far as making decisions as a shareholder. So whenever they do shareholder decisions, if you got to vote on something, you would only get that with the HEI-A shares. The HEI does not. And I also think Warren Buffett may be playing a bit of an arbitrage play here. Usually when you have two company stock that are basically, aligned with the same company, the only difference being voting rights, they're pretty closely matched. If you look at these right now, HEI is at 240 something, 245 maybe. HEI-A is under 200, around 190-ish. We'll see that here in a minute where it closed out the day. But I think there's a bit of an arbitrage play because, again, I think there's about a 25% difference between those two numbers, and usually they close the gap, right? So I think this might be a bit of an arbitrage play. I also think it might be a good one if you think that we might be in a prolonged period of war, like what's going on in the Middle East and over in Israel as well. But is a successful and growing technology-driven aerospace, industrial, defense, and electronics company. Since 1957, Heico has thrived by providing customers with innovative and cost-saving products and services. Heico's products are found on large commercial aircraft, regional business and military aircraft, as well as on a large variety of industrial turbines, targeting systems, missiles, and electro-optical devices. Heico Corporation operates in two segments, the Flight Support Group and Electronic Technologies Group. So again, if you think we're going to be in any kind of prolonged wars overseas, whether or not we have boots on the ground or not, our industrial commercial aircraft are going to be used in some of those, I am sure, in some form or fashion, as well as electro-optical devices, targeting systems, missile systems. All right, these are probably going to be heavily used whether there are troops using them or not. Now, the reason I am covering them today, down 0.27% on the day. Again, not a big drop. Also, like I said, I just recently was going through 13Fs that have recently come out. They are quarterly. I should go over the 13Fs that have come out. Warren Buffett is one that I always take a look at. Ray Dalio's another one. There's a few others out there. I always check out what their 13F, and that just tells you what companies they're buying or selling. This was one that Warren Buffett recently added. There are a couple other people that buy stocks under Warren Buffett's Berkshire Hathaway portfolio, so he may not have been the one that bought this, but they just added this to their portfolio. We are talking about Heico Corporation, ticker HEI-A. Again, there is another ticker, HEI, but the HEI-A shares that Warren Buffett was buying or did buy, they give him voting rights whenever they hold shareholder votes for whatever they're going to hold those votes for, whereas HEI does not. Okay. 52-week range as low as $124.33, as high as $200. So this one is not close to its 52-week low. It's actually much closer to its 52-week high right now. A market cap of $29.568 billion. So a small cap company here, a beta of 1.21, which means they're more volatile than the overall market, which means you might be able to use that volatility to your advantage. This one was right now, it looks like it's rebounded a little bit in the after hours, but if it was to continue to go down, you might be able to get a little bit cheaper. PE ratio, beta 1.2. PE ratio very high, 60.42. So this company, to justify a PE ratio like that, it has to be growing extremely, extremely fast. That is a very, very high price to earnings ratio. You are paying $1 for every $60 of earnings. That's just really high. EPS, earnings per share, sitting at $3.18 per share. Earnings date, August 26th, so that was today. So I'm assuming they either, met what they were supposed to met, or possibly had a little bit of bad news. Not a big drop, but they did drop slightly for being the day that they released earnings. Forward dividend, or they could have had adjusted future earnings outlooks. That could be a possibility as well. You'd want to check that out though if you're interested in this company. Forward dividend is 0.22, so 22 cents. They are a semi-annual payer, I believe, on this one. So we'll see what that is per share per payout whenever we get to the end of the video. Dividend yield, very, very low dividend yield on this one, 0.11%. So again, with such a high PE ratio, this may be a fast grower that just has a dividend as a show. So it may be more on the growth stock side. Ex-dividend date, July 1st. We are past that. Looks like they paid out on the 15th. 1 year target estimate of $185. They actually see it a little overvalued here. Yahoo Finance does, where I'm pulling this information. They see it at $185 over the next calendar year. So it needs to come down a little bit in their estimation to be fairly valued. And we're going to jump over to the right, look at dividend yield theory. To do that, we look at the 5-year dividend yield average of 0.15%. We compare it to its current 0.11%, or over here where it says forward annual dividend, 0.11%, same number. Since it is lower, that speaks to potential overvaluation on this one, ever so slightly overvalued. And that's in line with what Yahoo Finance is telling us, ever so slightly overvalued. Payout ratio is 6.29%, so very, very low payout ratio. They have a long way to go before they're in any danger of the dividend being cut, unless they just want to cut it. 2020 here, we're going to go back and look at free cash flow. To do that, we're going to jump back to 2020 here, a little trip through memory lane back in time. $386 million in free cash flow. Jump up in 2021 to $407 million in free cash flow. 2022 up to $438. It looks like a drop in 2023, but let's talk about that. Repayment of debt here. You can see $68 million, $505 million, $212 million, but then right here they jump that way up. So you'd want to compare this to the issuance of debt to make sure they paid down more debt than they took on. But I'm going to say they do have growing free cash flow, and the difference being from 2022 to 2023, huge increase in the repayment of debt, which I like that they repaid that. I want companies to be, as debt-free as possible. Now, jumping over to stockanalysis.com, another site that I go to for information. You pick any sites that you want. You don't have to use these two, but I would recommend more than one source for information, so you can make sure the information you are getting is accurate and up to date. And I know I said information a whole lot there. But they have 9 analysts that have taken a look at this. They call it a strong buy. They have a low estimate of $225. It currently sits 17.33% lower than their lowest estimate. If it hit their average estimate of $241.78, that would be a 26.08% increase. And their high of $250 estimate would net you a 30.37% increase. And I'll be honest with you, 241, that's pretty close to what HEI is. Like I said, I think this may be an arbitrage play for Buffett here. I'm sure he'd be happy with locking in a 20% jump for this to just meet back up with it. But HEI could do the other. It could come down to the 190s too. So you never know. Now we're going to jump over here and look at return on equity and return on invested capital to see how well this company is reinvesting its capital back into itself. I like 10% or better for these numbers. Return on equity is sitting at 13.87%. Very good there. Return on invested capital a little lower than I like at 9.02%. So it technically doesn't meet what I'm looking for, but to be honest, if it was that close and everything else looked good, I would probably go ahead with this. But we will say no check for that. It's only one of the two. I am thinking about breaking these two apart. EPS growth, I like 5% projected over the next 5 years or better, sitting at 16.45% projection over the next 5 years. Really like that. And the revenue growth, double digits at 12.69%. Very, very nice to see there as well. So maybe revenue, if it did grow at 12% a year for the next 5 years, maybe that 60 PE is justified, but that's still a very, very high price to earnings. Obviously, if the price per share came down a little bit, that would come down as well. Now let's look at the dividend history as we wrap this one up. Again, I said semi-annual payer. It looks like they pay out a couple of times a year, January and July, pretty consistently January and July. And they pay out, looks like the most recent payout was 11 cents. Going back to 2019, they were paying 7 cents. 2020, they raised it up to 8 cents. 2021 up to 9 cents. 2023 up to 10 cents. 2024 up to 11 cents. So I would anticipate another raise in January of 2025. And they are growing that dividend about 5.05%. Very low payout ratio. 6 years of growth. Buyback yield of 0.88% negative. Shareholder yield of negative 0.78%. They need to get better at buying back their shares when they do it. And we want this to go positive. Let's check out the screener here. See what this one looks like. So understand the business, that's where we started. Check there. Growing free cash flow, yep, check there. Growing dividend, check there. Dividend payout ratio, definitely under 75%, under 10%, check there. Dividend yield theory says it's potentially overvalued, no check. It is not within 15% of a 52-week low. The return on invested capital was a little under 10%. Return on equity was fine, so no check there. Earnings per share growth over 16% definitely meets the 5% or better that I look for. So 1, 2, 3, 4, 5. It is on my watch list. I'd like more of a pullback with such a low dividend yield. Again, I think this one might be an arbitrage pay. It definitely is one that Berkshire Hathaway, Warren Buffett's company, recently added to their portfolio for whatever that's worth. That doesn't necessarily mean you should run out and buy it. I'm just saying that he added it to his 13F, and that's how I found it. So don't think I'm trying to get you to buy it because Warren Buffett added it to his portfolio. That's not what I'm saying. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Hit that subscribe button. It doesn't cost you anything but a couple seconds of time. It really does help out a small YouTube channel like mine. Also, drop a comment down below. Make sure you click that notification bell so you're notified whenever we put out any new content. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Heico you'd like me to cover in the Stock Pick of the Day series, also let me know what you think of Heico. Is it a sneaky play in the aerospace defense area? I know that a lot of people maybe regret or feel like they may have missed the big run up on some other stocks in that area. Maybe this is the play. Let me know what you think down in the comment section below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, we'll see you in the next one. Thanks for stopping by. Thanks for tuning in. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.